So, what if I told you that three different charts are flashing the exact same warning signals that we saw right before the 2008 housing crash? Well, today we're going to break down precisely what those signals mean for 2026. Look, this isn't some crazy thought experiment. The data is real, and believe me, the patterns are repeating. So the real question is, are you going to stick around to see the proof and, more importantly, get a game plan to protect yourself? You know, right now, most people are running on this really powerful belief that real estate is a sure thing, right? That prices only ever go up. It's the story we've been told for years, and it's pushed prices to some pretty dizzying heights. But the cold, hard numbers, they're pointing to a potential day of reckoning. The story they're telling isn't about endless gains. It's about risk. It's about history. And it's a warning that I really don't think you can afford to ignore. So let's dive right in and start by understanding these signs. What exactly are these first warnings of a potential storm? We're going to focus on three absolutely critical indicators. First, the infamous yield curve, which, has an almost perfect track record of predicting this stuff. Then we'll look at the dangerous gap that's formed between mortgage rates and home prices. And finally, we'll look at a measure of affordability that is flashing red brighter than ever before. So yeah, think of this as a data-driven wake-up call. Okay, so let's start where the official story begins to crack, the expert forecasts. On your screen, you can see the 2026 forecasts from all the big names, the National Association of Realtors, Wells Fargo, Fannie Mae. And yeah, most of them are still calling for small gains, 2%, 3%, maybe 4%. It looks comforting, right? But look closer. See that red bar? The Mortgage Bankers Association is one of the few actually calling for a decline in prices. And that, right there, is the first red flag. When the experts start splitting like this, it usually means the market is getting unstable, a place where small shocks can turn into big crashes. And just so you know, this isn't some isolated opinion. Brett Jensen from The Street Pro puts it really bluntly. He says a year of pain for both residential and commercial still seems the most likely scenario as we move into 2026. So while the official consensus tries to stay positive, some really serious voices are sounding the alarm. All right, now let's turn to probably the most reliable recession predictor we have. I like to think of it as the economy's alarm clock. We're talking about something called a yield curve inversion. All it means, in simple terms, is that the interest rate on a short-term government bond is suddenly higher than the rate on a long-term one. Now that's completely backwards, and it signals that investors are getting really nervous about the near future. And historically, it has come before pretty much every modern recession. Now, take a look at the right side of this chart. Back in 2022 and 2023, we saw one of the deepest and longest inversions in history. Just look back for a second. The inversion in 2000? That was followed by the dot-com bust. The inversion in 2006? That came right before the 2008 global financial crisis. So yeah, that alarm clock has been ringing loud and clear. Okay, so here's the crucial part, the timeline. The crash doesn't happen the second the curve inverts. First, you get the inversion. Then there's usually this lag, about 12 to 24 months, where the economy has to absorb the pain of high rates. And it's after that the recession really hits. Well, that 12 to 24-month window after the historic 2022 to 23 inversion, it points directly at 2025 and 2026. So how does a potential recession actually translate to the average person? Well, that leads us right to our next major problem, the great affordability squeeze. This chart right here shows what I like to call the pain gap. The red line is the mortgage rate, and the yellow line shows home price changes. See what happened? In 2023 and 2024, mortgage rates just skyrocketed, but sellers who were still thinking it was 2021 refused to lower their prices. That massive gap between the cost to borrow and the cost of a home creates this crushing affordability problem. And a gap like that, well, it can't last forever. Something has to give. This whole dynamic is perfectly captured by our next indicator, the Housing Affordability Index. It's actually a really simple measure. If the index is at 100, it means a family with a median income can just barely afford a median-priced home. If it's above 100, things are affordable. But below 100, that means most people are completely locked out of the market. And folks, here is the knockout punch. The index has collapsed to the lowest levels in modern history. I mean, it's far, far worse than the levels we saw right before the 2008 crash. This is the chart that it should make everyone nervous. It shows that the very foundation of the housing market, the ability of regular people to buy a home, is fundamentally broken right now. Okay, I know that was a lot. We've looked at the warning signs, and they are serious. But now for the most important part. What can you actually do to prepare? Let's talk about a game plan to protect yourself. All right, 3 things. First, stress test your budget. Don't just look at what you can afford today. Ask yourself, could I handle my mortgage if my income dropped by, say, 20%? Second, secure your equity. With prices at risk of falling, now is not the time to take out risky home equity loans against a value that might not be there tomorrow. And third, build up your cash reserves. A strong savings buffer is your absolute best defense. It gives you options. It gives you staying power if you face a job loss or any other kind of financial shock. So, as we wrap this up, I want to leave you with just one question to think about. After seeing these charts and hearing these warnings, you really have to ask yourself, is your financial house built on solid rock or is it built on sand? Because the tide might just be going out.